Let me be completely clear. Every major financial crash looked obvious in hindsight. This one may be obvious in advance. Markets are sitting at record highs. Volatility is near record lows. Confidence is everywhere. And that exact combination has never ended well. Because the most dangerous time in finance is not when everyone is scared. The most dangerous time is when everyone feels safe. When risk feels like a problem from the past. When people stop asking, what breaks if this goes wrong? And start asking, how much more upside is left? Beneath the surface of calm markets, some of the most reliable warning signals in financial history are flashing red right now. Not opinions, not fear-mongering. Data. So the real question isn't whether something eventually breaks. The real question is whether 2026 is when the bill finally comes due. If you only look at headlines, everything still seems fine. Stock markets are near all-time highs. Artificial intelligence is supposed to drive the next productivity boom. Unemployment still looks manageable. Consumers are still spending. Wall Street loves this story because it's comforting, familiar, and profitable. It gives everyone permission to believe the hard part is over. It supports the idea that the last decade of gains is the new normal, and it feeds the most seductive phrase in finance. This time is different. We heard it in the late 1990s during the internet boom. Back then, profits didn't matter because growth was the new currency. We heard it in the mid-2000s during the housing bubble, when prices supposedly could never fall nationwide. We heard it again in the late 2010s, when central banks convinced markets that cheap money could last forever. Today, the belief is that artificial intelligence will change everything, and that the Federal Reserve will always step in if markets wobble. That belief has consequences. Markets aren't calm because risk is low. They're calm because investors believe someone else will absorb the risk for them. When people stop pricing risk honestly, they don't become safer. They become fragile. Because fragility grows quietly. It grows during long stretches of success, when nobody feels the need to check the foundations. And the foundations right now look stretched. The U.S. stock market is worth more than twice the size of the entire U.S. economy. That ratio can stay elevated for a while, but historically it doesn't stay elevated forever. When it finally reverts, it tends not to do it gently. It does it suddenly and usually when the crowd least expects it. So if we're asking whether a crash in 2026 is inevitable, we need to focus on one thing above all: the signals that show whether the economy is actually stable or just being held together by confidence. There is one indicator that cuts through the noise. One signal that has predicted every U.S. recession since 1950. No exceptions, no missed signals. It warned before the recessions of the 1970s, before the oil crisis, before the dot-com collapse, before the 2008 financial crisis, before the 2020 crash. That indicator is the yield curve. Here's the simple version. Under normal conditions, long-term loans pay higher interest than short-term loans. That's basic risk. If you lend money for longer, you demand more compensation because more time means more uncertainty. But sometimes something strange happens. Sometimes short-term rates rise above long-term rates. The yield curve flips upside down. That is called an inversion. The yield curve inverts when investors believe the future will be worse than the present. When they think growth will slow, when they think rates will eventually fall, when they think the economy will weaken enough that safety becomes more important than return. And when that inversion happens, recession always follows. Not instantly, not on a countdown you can set your watch to, but consistently enough that it has become one of the most watched signals in the world. What makes this cycle different is not just that the yield curve inverted, it's how extreme it was. The yield curve inverted in 2022 and stayed inverted for more than 2 years, the longest and deepest inversion since the 1980s. That wasn't a mild warning. That was the bond market screaming. But here's the part most people miss. The recession often does not start during the inversion itself. The recession tends to begin after the curve begins to normalize again. Why? Because the curve often uninverts when central banks start cutting short-term rates. And central banks do not cut rates because everything is fine. They cut rates because the economy is weakening, because stress is rising, because something is breaking. So the inversion is the warning. The uninversion is the danger window. That uninversion began in late 2024. If the historical pattern holds, the recession window is already open. The clock is running. Now, none of this guarantees a crash. It doesn't tell you the exact month. It doesn't tell you the trigger. But it does tell you something uncomfortable. The conditions for a downturn are in place, even if markets don't want to admit it yet. And markets have a habit of ignoring warnings until they can't. So the next question is, what kind of economy are we actually dealing with underneath record highs? Because the US economy has quietly changed in a way that makes it more brittle than it looks. The top 10% of earners now account for nearly half of all consumer spending. That is an extraordinary concentration. It means the economy is being carried by a relatively small group of households with high incomes and significant exposure to the stock market. As long as stock prices rise, that group feels richer. They spend, they travel, they upgrade, they keep the economy moving. But if stock prices fall, their wealth takes a hit. They pull back. They become cautious. And when that group becomes cautious, the economy can slow much faster than people expect. Meanwhile, everyone else is already under pressure. Real incomes for low and middle earners have barely grown since the pandemic. Excess savings have been used up. Credit card debt has pushed beyond $1 trillion. Delinquency rates are rising. That matters because it means the average consumer doesn't have much buffer left. If layoffs rise, or hours get cut, or credit tightens, there isn't a big pool of savings waiting to absorb the shock. The labor market has also started to show signs of strain. Hiring is slowing. Job openings are declining. Unemployment is edging higher. This is what late-cycle fragility looks like. The economy is not roaring, it is balancing, and the balance depends on confidence and asset prices staying elevated. Now, layer in government debt. U.S. national debt has climbed above 120% of GDP. Interest payments alone now exceed the defense budget. That is not a political point. That is a structural constraint. When interest costs rise, the government's flexibility shrinks. When growth slows, tax revenues fall. And when both happen at once, deficits expand at the worst possible time. At some point, markets start asking harder questions. They start demanding higher yields to compensate for risk. And higher yields can feed back into higher borrowing costs across the economy. This is where the central bank problem becomes unavoidable. The Federal Reserve is trapped. If it keeps rates high, recession risk increases. If it cuts rates too aggressively, inflation risks returning, and bond markets can push back by demanding higher yields anyway. And now there is another complication. Political pressure is openly being applied to monetary policy. Markets are betting that asset prices will always be protected, that someone will always step in, that there will always be a rescue. History suggests that bet eventually fails. Central banks can delay downturns. They can soften them. They can buy time. But they cannot erase the business cycle. They cannot make debt disappear. They cannot permanently protect valuations from gravity. And this is why crashes don't happen when people expect them. They don't happen when fear is highest. They happen when confidence is highest, volatility is lowest, and risk feels far away. They happen after long periods where nothing bad happens, because that's when leverage builds up and when people stop preparing. By the time the headlines turn, the process is already underway. No one can tell you the exact moment a crash begins, but we can identify the setup. Extreme valuations. Record debt. A yield curve signal with a perfect historical record. A consumer base that is split between those still spending and those already strained. Artificial calm in financial markets. Political interference in monetary policy. This is the same pattern seen before every major financial break. So, is a crash in 2026 inevitable? Maybe 2026 becomes the first exception in modern history. Maybe the yield curve finally fails for the first time in generations. Maybe the economy threads the needle and markets glide through. But if it doesn't, then the next 12 to 18 months are exactly when the consequences would appear. That is the window where fragile systems tend to break. That is when markets go from ignoring risk to repricing it all at once. The warning signs are already here. What happens next depends on whether we choose to listen this time.
Please like, share, and subscribe to the We Do All of This channel.